There are two things that every child on this planet wants. Every child wants certainty. That's why kids thrive when they know what the rules are, where the boundaries are. They may scream and shout when they bounce up against the boundaries and you tell them not to. But deep research has been done that kids do much better when there is fixed rules for them growing up. So those rules give them certainty. They know where the boundaries are. And the other thing children want is the knowledge that they belong. And who they want to belong to is their family, namely their mom and dad. So as these children grow up to become adult children, and these adult children, all of us, want the same two things. We want certainty and we want to belong. So whenever uncertainty hits anywhere in someone's life, someone dying prematurely, the stock market moving in a direction you didn't expect, it really makes us adult children really think about certainty and want that certainty and look to how we can still belong. So in 2008, when Bernanke started dropping rates and started his printing press of printing trillions of dollars, it was to end uncertainty. Well, today I want to talk about kind of a side effect of adult child Ben Bernanke wanting to eliminate that certainty and what it means to your portfolios going forward. Hey everybody, this is RC Peck, and this is my weekend podcast. And the theme for this weekend, or at least what I'm calling the podcast, is Bakken wins. And the Bakken shale basin is one of the largest. That and Eagle Ford are the two largest shale basins in North America, or at least the two that have been discovered. And one of the interesting things that came out of Bernanke and Yellen, really Bernanke, printing $3+ trillion was about $500 billion of money flowed into the energy industry. And it flowed into the energy industry by energy companies borrowing money at ridiculously low rates. And a lot of what these energy companies had to borrow at was on very good terms to the lender because their balance sheets were not really able to support a better rate. So when a company has to pay a high yield because it's riskier, they're called junk bonds. And a lot of the junk bonds went into the energy industry since 2008. Well, that's pretty good because a side effect of that $500 billion going in was that the Bakken and the Eagle Ford and the Permian basins, just to name a few, they were the winners. They beat Silicon Valley in the sense that they created the new best technology that has impacted our country. The United States has more energy. We produce more energy than any other country on the planet. Now, Saudi Arabia has the easiest oil that it can get to. It's very easy to get to it. But as far as total gross energy that is produced, the U.S. produces more energy than any other country on the planet, which is pretty amazing. So one of the side effects of Bernanke and then Yellen printing the trillions of dollars is we've gotten ourselves cheaper oil. Now the question is it going to get cheaper? And what's going to happen to the market? Well, one of the things I want to look at and why I brought up this topic this way is because the junk bond market is unhealthy right now. And a noticeable or significant amount of junk bonds are from the energy sector, which has just finished a 40% fall, which is amazing that an entire huge sector like that has fallen 40%. It has since bounced and is up a little bit. The question is, has it finished falling? Is there a reprieve? What is going on not only the energy sector, but how will that influence the stock market? So with that, I just want to show two price charts. And these price charts right now, I think, really say it all. So the first price chart I want to point out is what I'll call a weekly price chart of junk bonds. And back here in 2011, when Bernanke saved the day and came out literally at the bottom of this, like by the hour, he's saying, okay, I will print another $1 trillion. The junk bond market went up. Now, if you can see, it was actually pretty stable going into 2011 and really corrected down, if you want to call that a correction, really fell. It fell from about 41 down to about 36, which for bonds, that's a significant fall. And then he printed money, Bernanke printed money, and it moved up. But if you notice, it peaked right here. Junk bonds peaked here in about May of 2013. They tried to get above that same price in about July of 2014, but had been falling since then. And now we have junk bonds that have bounced off their 2011 low. And really, to me, this is kind of the canary in the coal mine. We're watching this, it's bounced off its low, which is very expected. Usually when there's a significant bottom, when a price gets to that, it usually will bounce off of that. Buyers usually come in at the same price, and that's in fact what is going on now. But then we have here a daily chart. You can see up close, I just zoomed up close. It kind of went below that line in 2011 and has moved up. So now the big question is, where does this go? We've had a nice move down. Of course, it's not nice if you own junk bonds from June until the beginning of October. And so we could probably expect a little bit of a move up higher. This is the 200-day moving average, and not only is it not sloping, I would say it's clearly falling. So the junk bonds right now have bounced, and that's given some life into the market. What's interesting is small cap and mid cap are definitely underperforming the large cap, which probably means people who have gotten back into the market have said to themselves, hey, if I'm going to go back into the market, I want to go back into the safest stocks. And so the Dow Jones 30 large stocks has done better than mid caps or small caps. So the takeaway is expect more volatility. Now, no one ever calls volatility to the upside volatility. They call that a win, excitement. I love it. People only think of volatility if the price moves down, but expect more volatility. The market is not over from trying to decide which way to go. It's had a big move up over the last, say, 10 days. That was after a big move down, and there's still a lot of volatility coming into the earnings season. So just expect the volatility, and again, it can be to the upside and it will be also to the downside. And follow your strategies. Stick with your strategies. Thanks, everybody. And this is just another step in helping you protect your portfolio and protect your future. Until next time, this is RC Peck.